Next on the agenda is a panel discussion being moderated by my friend and colleague, Patrick Goodman. Patrick is the Managing Director, MFS Africa UK, and is also responsible for banks, institutions, and governments, a business unit within MFS Africa. He joined from UBA, where he was a CEO, and he's based in London. He's a seasoned executive with a diverse background and experience in managing cross-cultural teams. Patrick will introduce the members of his panel. Patrick, you've got 40 minutes, and come and take it away.
One more coming. We're just waiting for our final panelist who's getting mic'd up. Good afternoon, everyone. Welcome. This is a panel discussion on fintech and particularly focused on investment opportunities beyond payments. I'm delighted to be the panelist. My name is Patrick Goodman. I'm with MFS Africa. For those of you who don't know us, we are one of the largest digital payments network, Pan-African digital payment network. We run a real-time currency agnostic payments network that reaches or cuts across 36 markets and reaches 320 million mobile wallets and many, many millions of bank accounts. And do so through working with partners across the continent and outside of the continent. I'm delighted to chair the panel today, and I will introduce the panelists shortly, but I thought I would just pose a few questions that will sort of drive our discussion today. I think in many ways we would all agree that Africa is leading the way in terms of innovation and mobile banking and the use of technology to solve everyday problems. I think we find that collectively the fintech community in Africa is vibrant, very innovative, and really driving and making a difference. Yet, many African fintechs struggle constantly to find the funding and the support that they need to continue that growth. Why is that? So I think that is the first question we want to sort of probe a bit. Secondly, the headlines are predominantly dominated by a few players in a few markets. I don't need to mention names. I think we know which players in which markets. Yet there's so many other players. Why are they not getting the attention that they need? Why is that? Second question. And finally, despite the continued development across the continent, and I think real attempts to change the narrative, Africa is still viewed as extremely high risk and therefore is often out of sight for many investors. Why is that? So those are the three kind of overarching questions that we will dig into today. On that note, let me just introduce the panelists, and I will ask each of them to spend just a few minutes introducing their company and also some takes on some of these questions that I posed. So I'll go from left to sitting on my left is Yves Unet, Chairman, TagPay. Chairman and co-founder of TagPay, an international fintech company has developed a next-generation core banking system. He has over 25 years of experience in banking innovation and technology. Previous to that, he was Director of Innovation at Gemalto, focusing on smart card technology. Yves has also published a book, which I recommend you all pick up. I haven't done so myself, but I will, called Fintech, The Banks Strike Back. Welcome, Yves. Next to Yves is Simon Tobelem, from Group CEO from Airy Capital. Unfortunately, Simon is the last addition to the panel, so I unfortunately don't have Simon's bio, so you will have to introduce yourself when we get to you, Simon. So sorry about that. After Simon, we have Jyri Aunen, Head of Digital Infrastructure and Solutions, FinFund. Jussi Ahonen. Jussi is leading the origination and execution of digital infrastructure and solutions investment at FinFund. Digital Infrastructure and Solutions, DIS, is a newly established team within the investment function that invests in commercially attractive, high-impact businesses within the emerging markets digital value chain. Prior to joining FinFund, Jussi was a corporate finance advisor at EY and has worked in various emerging markets investment banking roles at Standard Chartered. Welcome.
Thank you.
Next to Jussi is Chris Wehebe, CEO, Lendable. Chris is the Chief Executive Officer of Lendable. Previously, he was a partner of Aerograss Capital Partners, where he served as head of relative value globally for the multi-strategy firm, overseeing the convertible arbitrage, volatility arbitrage, and capital structure arbitrage strategies. He also served as Chief Investment Officer of the firm's tail hedging product, the Aerograss Vega Fund. Prior to joining Aerograss, Chris was part of the European convertible bond trading team at Lehman Brothers. Welcome, Chris. And finally is Vahid Monajem, CEO of Nomanini. Vahid is the co-founder and CEO of Nomanini, an Africa-focused pioneering fintech platform for the informal retail ecosystem. They connect merchants and distributors to each other and to global service providers, integrating payments, working capital, and data analytics to unlock the latent potential of Africa's economy. He's an engineer with innovation and product design experience, and before establishing Nomanini, he was McKinsey and Company's Global Fellow for Emerging Market Product Development. Welcome. So, if I can ask Yves to maybe kick us off with a few words on your take on the topic at hand. Obviously, we're talking about investment opportunities in fintechs, but particularly beyond payments, which oftentimes gets all the attention.
That's right. So thank you for the introduction. As Patrick explained, we are a company that is delivering to banks IT infrastructure in order to develop digital banks. So I'm a big defender of banks. I love banks. I think banks are extremely important in the local economies in every country. And it's maybe because I'm defending the banks very much that I'm going to make a little critique on the banks today. If we speak about fintech, when we see what's happening around the world, fintechs are successful, are capable of deploying, are capable of raising money if they have around them some strong banks infrastructure that can host them, that can connect with them, that can bring them all the knowledge, all the expertise of banks. And today, African banks are still in the process of becoming digital, are still in the process of having what we call an open architecture, which is required to connect to those fintechs. And I would say today, the struggle that the fintech go through is still due to this lack of simplicity of making business with the bank, being complementary with the banks. The banks need the fintech and the fintech need the banks, and today, because of technology infrastructure, we're not speaking about strategy, or we're not speaking about, I would say, decision. We're speaking about the infrastructure of the banks that are not adapted to this new world where the fintechs are, because the fintechs are obviously 100% digital, and it is a barrier, a difficulty for them when they're in an environment when the banks are not open, are not capable of cooperating with them. That's what I would say now. Maybe, I'm sure there are many other reasons, but this is my technology angle that makes me say that.
Simon?
Yeah. Yes. So the good thing of not having been introduced is that I can say whatever I want about myself. You don't have to believe me. So IA Capital is a group we founded 7 years ago. We are an international and entrepreneurial financial services group focusing on emerging markets. So we have a first activity, which is asset management and venture capital around China and Middle East. And we have a second activity, which is more relevant for today's panel, which is corporate digital banking in Africa and around from and to. And the idea was that a lot of people are talking about underbanked population in Africa, and they're focused on the retail. In truth, there's a massive gap for the corporates, whereas Yves was mentioning about the banks, and traditional banks have left Africa, the Western ones, and the new ones, the local ones, are not dealing with corporates, which means that today, in order to develop and foster investment in Africa, there are not many players, and that's definitely a gap. So we've built a digital bank out of Mauritius, although we are headquartered in London, and we have been for the last 2 years operating and offering an alternative to corporates who want to develop in Africa. As for your question, Patrick, I think that it's indeed a question of building an ecosystem, technologically speaking. Clearly, as Yves was mentioning, you need to have the right tools, including Sandbox and Toolbox to connect the fintech. But it's also, I think, quite a natural transition from a world that was focusing on payments, where Africa has, I think, last year, 490 billion in volume of payments, towards a world focusing now on digital banking and digital finance. So that's also quite a natural transition.
Thank you. Jussi?
Thanks, Patrick. Pleasure to be here. And FinFund is a Finnish impact investor, DFI. We invest both institutional capital and government capital, and we feel that digitalization is important topic. Narrowing down the digital gap is clearly our focus area, and why we feel that fintech is efficient tool is simply you can bring financial solutions to the people who weren't able to access those before. It's lower unit costs, scalability, just being able to do things smarter than before. So clearly we feel as an impact investor that it's also scaling the development impacts, not just the capital, not just growing the revenues, but you can multiply the impact of those businesses, and that's why we feel it's important to invest in the sector, of course in a responsible manner, but say lending marketplaces is a great tool to provide people access to those financial choices that they didn't have before. Thank you.
Thank you. Chris?
Great, thanks very much. My name is Chris Raby, I'm the CEO of Lendable. We are a debt provider to fintechs across emerging and frontier markets, covering Africa, Southeast Asia, and Latin America. Actually, I think this panel is a particularly interesting topic in terms of the background that we come from, in that the inspiration to start Lendable really did start from Africa, and in particular Kenya and the advent of M-Pesa, and very much for some of the themes that have been talked about today, and also actually from the discussion from Paycode prior to this, that the advent of digital money and of mobile sort of technology allowed you for the first time to really be able to identify individuals in a way that was traceable, in a way that we could look at over time. We could start to understand characteristics of those individuals in terms of their propensity to repay, if it was a loan, or at least their biases in terms of different spending. And in that sense then, as a business like Lendable, be able to finance companies that ultimately were involved in those sort of activities. And so very much a business that was born out of this idea and out of this African innovation. In terms of then what we cover today, it very much is not just payments, although payments is a considerable part. It's really extrapolated to other users of that sort of technology. So we finance 5 segments. On the lending side, we look at SME lending, asset lending, and consumer lending. We also cover payments, although I would say that payments in itself is sort of a very broad term. I think within payments, we'd look at both cross-border, so remittance-based businesses, also payment infrastructure, and then mobile money. And then we also look at marketplaces. And I say most classically in Africa, that might be something like logistics, where again, this idea that you could use a financial solution whereby you can pair different buyers and sellers together in a traceable way has meant that we could lend and continue to do so.
Hi, my name is Vahid. When I'm not being late coming back from COVID tests, I'm running Nomanini. Nomanini is a fintech focused entirely on informal retailers, and on enabling them to improve their businesses and their livelihoods with digital financial services. And this topic I really actually quite like, because our journey has come from doing a narrow set of payments, enabling a narrow set of payments for informal merchants, and gradually over the years adding more and more payments, now adding credit, and soon other services to the stack. And so I think the opportunities beyond payments are really exciting for me. I do not come to this industry or panel from a banking background. I come much more from a design background. And in that way, I get very excited about the problem and less worried about the solutions. And I think that's a trend that I'm excited to see. There's this incredible progress in the banking infrastructure, in KYC, in the cost to process small transactions. And I think the shift is now starting to enable specialists to focus on very specific domains to solve very specific problems. So that's an area that I think that we are a manifestation of. You wouldn't think high trading informal retailers is a global segment, but in Africa, 90% of 90% of retail is informal. So it is a rather big niche that when we came into this business is entirely underserved. No products for them to simplify their transactions or their operations or to manage their businesses. And so I think there will be more and more specialists using the platforms that are emerging. In terms of investment opportunities, we focus very much on, we're not investors ourselves, we do benefit from where investors place bets, so maybe I'll hold my tongue there. Though I think as an operator, there are a lot of, I wouldn't say stranded assets, but very underutilized assets in many countries that I think with the infrastructure and specialists, you can really unlock entirely new utility in a lot of these markets. So that's what excites me about the topic.
Let's explore that a bit more, and maybe Chris or you see as sort of investors, debt or equity, what are some areas within the fintech space in the broader sense, beyond sort of payments, which have gotten a lot, what are some areas where you see there being some very strong opportunities going forward?
Well, if I start, if I may, I mentioned the lending side of fintech is something we look closely. So not just consumer, but SME lending is something you can utilize the big data, use that data to make your processes more efficient, smarter, and I think this COVID era has shown that people and companies were forced to move from the traditional routes, if there were any available, to digital, and the results have been really good. At least what we've seen, I don't know if you've seen the similar, but the credit quality has improved during the COVID, and I don't think there is way back anymore, so we expect that to continue, and that's definitely something we keep on looking.
Yeah, maybe I could build on that point. So I think COVID was a very good test case for a lot of the fintech lending businesses. And it both, as for us as an investor, in the way that we could speak to them and the timing with which we could speak to them, and then also them and their ability to change parameters and lending criteria quite quickly. So Lendable, with each of our underlying investee companies, we integrate with their loan management system. We also integrate with their banks such that we can cross-check and verify their balances and their repayment histories. And what that means is that we have a live oversight over the underlying portfolio of loan receivables. And I only reference that because that wouldn't be possible without this sort of digital type infrastructure. And what it means from a practical perspective is that you as a lender, in our case as a lender, can have conversations much more quickly. So when COVID or a lockdown occurred, we could look at the impact literally within a half day and start to see how repayment rates would be influenced, and therefore have conversations much earlier than a traditional lender who might have to wait for quarterly compliance certificates or something of the nature. So from an ability to invest, it changes. And then equally, I think as Jussi was alluding to, from the potential of the actual on-the-ground lenders, because they have more incoming data, because they're more flexible in their approach, it's not just bricks and mortar, but it's through an app or through a website, they can quickly change their criteria and adjust to shock. So I think that's something I concur with.
Maybe Simon or Yves, data can obviously help shape some of that, both the perception of it being risky, because the more data you have, the more knowledge and information you have. In your respective areas, how do you use data to help change that narrative, either of you?
Well, yes. Okay. So, well, I think that first of all, before the usage of data, we should talk about the collection of data, because that's one of the key issues you have. It means you've got contradictory needs in between where the regulation goes with GDPR, etc., and the fact of collecting as much data you need in order to be comfortable with extending a loan or allowing for an investment. So the idea is in fact, and the idea where we actually trying to tend to, and we have an ongoing project on that within our digital bank, is to develop a portable identification. So the idea would be that in fact, the client owns his data and is the one responsible for releasing the data when we need it, depending on which kind of product or financial product we are going to offer, or which kind of financial product he wants to access. In that sense, you are solving the contradiction where today it's actually very difficult. And of course, in that direction, you need to use a technology which is secure enough to allow for this data to be unimpaired, unharmed, and tempered. So blockchain is certainly the direction we're taking. So that's the solution we are looking into, because today data is actually more a pain than something you can properly use.
Yes, and I would say that when you start to work with digital technology for banks, data is at the center of everything. I mean, we in our platform, we tape, we store every single event that is happening on the platform in real time. And that solves the problem of the reliability of the data. Very often in the past, data were difficult to combine or to analyze because they didn't have the same format or the same codes. Of course, with the digital era, all that can be worked on together, and there is a high level of reliability in the processing that you do of your data. Now, I would say, it's not just data in the bank. It's also the idea of being able to share with all the relevant rights of using of the data. But those structures of banking used to be organized around a very secure and very safe environment that it was extremely difficult to connect to. Those digital banks now are designed to securely share information and get information from outside in order to process new service, new offer, and sometimes a new, identify new customer, etc., etc. And therefore, because of that, the data is becoming more and more critical, the data processing. And we have now tools that are absolutely spectacular, that are made to use those data to improve either the bank security or the bank offers to the customer, and this is obviously critical.
If I could,
yeah.
I think the point about data, and I think you mentioned the quality of data we found is also very important. Probably more important than the quantity. So to give you an example, we have lots of small retailers, bricks and mortar, who don't have access to working capital to get stock. And we're not trying to lend to them, really. We're trying to improve their businesses. So our goal isn't to shovel more loans their way, it's to solve a problem. And some of the problems are, a retailer doesn't want to close their shop to go cash up their physical cash. They want to do that when it's convenient for them. It just so happens that lending is actually a really handy way to enable that to happen. Similarly, they need more access to stock to sell. Lending is a really great way to enable that. The interesting thing about data that we found is it doesn't take a heck of a lot of it. You can actually extrapolate if you have very reliable, consistent data. And actually, we had a conversation with a specialist who predicts sales in big supermarkets. And she said, you can give me the sales just of milk, bread, and maybe one other category, and you give me the square footage of that shop, and I can tell you, I can build the business, I can give you the business model of that shop. I can tell you their income statement. And I think that kind of the idea of key value indicators for businesses is super powerful. We've applied that to small stores in order to credit rate them just using digital transactions that we can track very reliably with their customers. And then building on that, once you start to get repayment behavior, you can get to the next level of loans. But yeah, data is super important, but consistency and quality we found is quite hard to come by.
And I mean, I don't want to belabor the point around data, but clearly that is one means by which, and we're talking about investment opportunities, by which one can spur more investments. The greater data investors have, or the flip side, if you are trying to sell yourself, the more you can provide. I mean, have you seen, if I look at you see, and Chris again, as sort of, lending into various industries and companies, have you seen an enhancement, an improvement in the data accessibility and availability? Or is it, in particular, Chris, I'd be curious because you operate not just on the African continent, but also in Southeast Asia and Latin America and so forth. Do you see a difference?
In terms of cross-geography, I don't necessarily think we see a quality difference. And I think, but there is one sort of key metric, which is the way we deal with data. So we have the data that's provided to us by our fintechs, which is basically integration with their loan management system or whatever it might be. And so it's the self-reported data. And we consistently see that that's not always correct. In fact, it's never correct. I don't think we'd ever see a borrower for whom that is all 100% verifiable. The key bit that we do is then verify it against cash. So we look at their mobile wallets or their bank accounts, and we basically match each transaction. And then we think we get really good quality. To your point, the quality of data becomes very good. And so I'd say that if there was something that was similar across geographies and across segments, it's that the raw data is never of perfect quality, never of good enough quality, and so it needs that verification stage. In terms of whether that's improving or not, I certainly say it is. I think you're seeing, the fintech space was dominated at first by a very fragmented, sort of very startup-y kind of environment. And whilst it's still fresh with new players, you're now being able to see some very established firms that are sort of bringing with them maybe the advantage, some more experienced people from more traditional finance or more traditional segments, which blends quite nicely because it brings in the process and the sort of accuracy. So yeah.
Yeah, and I completely agree. I think one important factor in the quality of data is, of course, the source. So I don't think it really matters whether it's in Africa or Asia, the source of data, whether it's from MNOs or from FIs or anything. That's something that we feel that varies a lot. So and it can be from within the same country, just a different operator might have really different quality of data. But coming back to Vahid's point on quality and quantity, what we feel that quantity is though important, of course. More data points you get, many times better quality of data, you are able to draw from that you understand that data better. But yeah, it's hard to tell, and as an investor, you can only go that deep, and then you need to trust your companies that they know what they're doing. But yeah, it's an important topic.
Looking at a slightly different, so if we move away, sort of, and again, the topic is moving away from payments, neobanks, digital banks. Clearly, they are getting a lot of attention. Eve, maybe starting with you, and then Simon. Views on neobank, is that the future of banking on the African continent?
Well, yeah, I was in a panel last week. we were debating on the idea: are the neobanks going to replace the banks? Neobanks are extremely important because they are showing to the banks the way to go. They are pioneers. They are bringing to the market some new process, new technology, new offers. Sometimes they serve the customer a better way, so they play an extremely important role. But now, to say that they're going to replace the bank is for me a step too far, because banks will adapt. And not only they will adapt, but they will also be able to purchase neobanks. So all that together, for me, neobanks is the best tool to progress and to bring the banking industry towards the digital, which is mandatory, because the bank architecture is a little bit late in its evolution, and the neobanks are this engine that is capable of bringing the banks in this new world.
So I would say in our case, more specifically, we are not replacing, we are a digital corporate bank, we're not replacing a bank, more than in the sense that we're filling a gap. So unfortunately, if you're a client, or fortunately, if you're one of our shareholders, we are very alone on that segment at that moment, and that's quite interesting. But obviously, we expect competition to come, because corporate digital banking is definitely a very interesting segment. But if we look more at the global picture in Africa, what we can see is that payment, as everywhere else in the world, is consolidating, and it was based on low-tech, high fees. So using basic phones where clients were paying high fees. So the 4 operators today in Africa are making a huge amount of money out of payments: Vodafone, Orange, MTN, Airtel, etc. And it's moving away from there, where now there's a pressure on fees, so it's lower fees, whereas at the same time, it's more high-tech. So you've got low-cost Chinese phones coming in Africa, where actually you can have access to digital services. And therefore, under this pressure, digital banks are not only a replacement or a challenge, but they are an alternative for existing and new operator to find revenue sources or alternative revenue sources. Because if your payment source, or which was the biggest contributor, is now under pressure, you have to innovate by, for example, offering lending products, investment products, trading products that you're going to spread for your retail or corporate customers. And that's why digital bank now is not just serving the underbank, is actually the new dynamic for financial operators to generate revenues in Africa and elsewhere.
I'd like to ask you for some advice. If we go to the last question that I posed, which is many African fintechs are still struggling to get access to the capital they need. So you can either take the side of being an entrepreneur, give advice to how should a starting fintech, how should they position themselves to gain access to it? Or you can take the perspective of being a lender or an investor. What is it that you would like to see or look at when you look at fintechs, so that they can actually get the access that they deserve and should? Wait, I'm going to start with you.
Oh, it's a tough one on this. So we are that entrepreneur, that fintech looking for funding.
Always looking for funding.
Always looking for funding. I mean, fundamentally for me, it's a question of making sure that the time that we spend with investors, that there's reciprocity in terms of respect of the time we put into educating or showing new markets and new opportunities to investors. So that's one. The barriers, I think that's going to be answered by investors. I will say that for better or worse, investors are human, and it is hard. It is easier to be wrong in a group than to be wrong alone. And it is hard to kind of break that dynamic of there's an exciting thing that a lot of people, a lot of investors are piling into. That is a much easier thing to do. And I can understand and empathize why that's an easier thing to do than to say, okay, let's catalyze something different. And so, yeah, I think the question I often have for investors is, what's the zag? If everyone is zigging that way and doing that thing, certainly you're going to find opportunities that are undersold on the other side to buy. So I'd love to see more investors zagging where everyone else is zigging.
Who wants to speak from an investor perspective?
Well, we are human beings, right? So, but yeah, that's true. But to me as an investor, what it's me as when I look companies, and I hate to say no to so many great firms, and it's not because I don't trust the product or I don't trust the entrepreneur, but I think what can be successful is that you have a clear story that investor like us can understand. So that there's a clear problem you are solving, and then you are able to explain it in a way that we can explain it to our boards and investment committees. And of course we need to have that view that there will be future in the business-wise, and this is something we can add value. But I think it's much of the storytelling and timing as well. It can be wrong timing and a great company, and it can be unfortunate. But I think simplicity for simple people is a good solution sometimes.
Any other thoughts, anyone?
I could maybe add a couple or three things really. First one I'd say is I think this is particularly important for this kind of audience, is to recognize that in an African context, there are certain impediments that will make it difficult that there isn't a solution to, or an easy solution. I think about things like capital controls, certain currency risk, regulatory risk in certain places. So that's why most capital flows in just a small number of countries in Africa, so I think it's worth recognizing that. That's not any problem. Second, I'd just say from being a debt provider specifically, if you're a company looking for debt finance, don't show us your equity model with crazy projections that no one's ever going to hit. You don't need to show us that, we just need to know what's really going to happen. And the last thing I'll say is just as a general point in terms of raising money, which goes for us as Lendable just as much as anyone else, which is that these days institutional investment is done through due diligence, it's done through, I don't want to call it box ticking, but basically you have to be able to meet all the different criteria. And so really there isn't a shortcut to just making sure that you get everything in order, be it from a compliance standpoint, a finance standpoint, the product standpoint. You just really have to do the work to make sure that you present things in the way that the investors expect to see.
Any final comments? Well, Simon, Yves?
Yep. No, I would say I think that if investors would be well advised to look also at the bigger picture and more than short-term investment. We have too much of that, too much of a short-term, too much of very narrow, and as you were saying, I think bigger picture is quite important.
Final word.
Yeah, I will
no
add
pressure. Final word.
Right, for the fintech here, I would say just a few things. First, never give up. Never give up. Feel the wind, catch the wind, go with the wind, and then probably the wind will go your way, and you will find finance. It's a long, hard trip, but if your idea is good, and of course you believe it is, so don't give up and keep fighting.
On that note, we've come to an end. I thought those were perfect final words. So thank you very much. Thank you, everyone.